In today's video, folks, we are investigating Tesla. Now, they do report their earnings this Wednesday, July 19th. So this is pretty much a preface to that earnings report, because if you're an investor looking to buy Tesla, this video is for you. We're going to investigate what the company's doing right, what they're doing wrong, and find the intrinsic value of this business so you know if you're getting a good deal on this business. So take a look at this. Currently, the time of recording this video, stock is up 3%. For Tesla, their earnings seasons has been pretty decent over the last 4 quarters. From Q2 2022 to Q4, they have managed to beat their earnings, and Q1 2023, they met their earnings. So coming now for July 19th, we'll see if they manage to beat their earnings once more or if they meet them again. Anyways, regardless, it's been a pretty positive year for this business. Now, what does that mean for potential investors? Well, when you see a company performing well, that's what's pretty much driving the stock price forward. On the 52-week range for this business, we hit a low of 101.81, and currently we've seen a price high of 314.66. So something to keep in mind, folks. Positive earnings usually means positive stock price movement, which doesn't necessarily equate with a positive business outlook. And listen, so when I say that is because, yes, the stock price may be moving well. Yes, they may be beating the earnings. However, it may get to a point where the stock prices, it doesn't justify how the business is being perceived. And I'll tell you what I mean by that. You're looking at Tesla here, and it's almost a $1 trillion business. And currently the revenue for the trailing 12 months is $86.04 billion of revenue. Net income is $11.75 billion of revenue. Free cash flow is $2.9 billion on average, and currently it's at $5.78 billion of revenue. To me, this seems somewhat low, and I'm going to bring up just another company here, Microsoft, where it's a $2.56 trillion company, but they're bringing in revenue of about $207 billion for the trailing 12 months. The net income is $69 billion, as well as the free cash flow is sitting at $47 billion on average, and $57 for the trailing 12 months. Granted, I know they're two different industries, but this seems much more appropriate given the current market cap. Now, I'm not saying that Tesla is wrong in that sense, but it's something just to keep in the back of my head is if this is a misprice, which we will investigate later on. Now, the software here is investigating the last 5 years on bringing out the averages of their financial statements to see where this company kind of currently sits in terms of financial health. They're getting a rank of 6 out of 10, which is honestly is not a terrible score, but it's somewhat mediocre, and they're getting dinged in 4 categories: the price earnings ratio, the return on equity average, the share dilution, and the return on invested capital average. Now, the 2 points that I want to bring forward to you folks is something to keep in mind is the price to earnings ratio sitting at an astronomically high 391 on average, which means that you are paying a high premium for this business. But currently the trailing 12 months price earnings ratio is 78.21. Now, even though it's lower than the 5-year average, you're still paying a premium for those earnings. So for those folks that are new to investing, price earnings ratio is pretty much a metric to say, well, how much am I paying for $1 of earnings? Obviously, the lower the number is, the more bang for your buck that you're getting. Would you pay $400 for $1 of earnings compared to paying $78 for $1 of earnings? See what that metric is there? So yes, you're still paying less for those earnings, but 78 is still high. We want to find companies that have a price earnings ratio below 22.5 and lower, because that just indicates to us that there is still room for growth. And yes, you're still paying a little bit more for those earnings, but it's way fairer than paying above 30 price earnings ratio, or in this case 78. Now, apart from that long-winded explanation, the other metric I want to bring to your attention is their share dilution. Over the last 5 years, Tesla has been diluting shareholders. We want to find companies keeping share counts the same at the very least, but ideally decreasing the amount of shares out there That way, you as a shareholder are able to get more pieces of the profits when they eventually get distributed. Essentially, when they dilute shareholders and adding more shares and pumping them into the market, now you're sharing those profits with other people, which is not great for the investor looking to buy this business. However, the counterpoint to that is that as a positive, the debt to equity ratio is actually extremely low. Now, the debt to equity ratio is a ratio that rates how financially leveraged a company is based off equity or based off debt. Basically, how are they funding their business? If it's equity based, like through common stock, that ratio will potentially be lower, and if they're raising it through debt, the ratio will obviously be higher. So, in regards to Tesla, they are funneling their operations through equity, hence the share dilution, which honestly, in this economic climate with high interest rates, not a completely bad move to take on, because now debt's being more expensive to actually acquire and pay off. So having more common stock to fund your operations, not a bad move. However, the people that do get affected in the end are the common stockholder, because now, as I said, you're sharing those profits with other shareholders. Now, apart from that, they're actually doing pretty well in other categories. Their revenue growth is up, free cash flow is up, the net income is up. So a lot of positive movements with this business. The only problem that I have is, are these numbers a little bit too low given the market cap? We're almost at $1 trillion market cap, folks, and we have these low revenue growth numbers as well as their high price earnings ratio, which is something I don't like. What I'm going to do, folks, is punch those numbers here into the price analysis section of this software. And if you want to get your hands on this software, folks, follow the links in the description box below. 7-day free trial. It's a great screening tool, as well as it has an intrinsic value calculator, which I'm going to show you what that looks like right here, right now. So these are the historic numbers of the business over the last 1, 5, and 10 years, if obviously available, if the company's been out that long. And here I could put those assumptions in based off what I believe this company might do over the next, 1 to 20 years. And I like to choose 10. And I'm going to click calculate in just a second, but I want to show you what I did. I like to try to stay as conservative as possible. So I pretty much split the revenue in half and said 20, 24, and 28% going forward over the next 10 years. Now, this is a $1 trillion company, though, folks, but given the amount of revenue that they've performed over the last little while, these numbers may be able to be hit. Profit margin, I'm staying very similar to what they've shown over the last 1 and 5 years. I'm giving a haircut to the 1-year number, considering that it's 15.45%, and currently the trailing 12 months the profit margin is 13.66%. So I'm trying to stay within that window there. Free cash flow, same thing, just giving a haircut at the 1-year number, and putting, more importantly, a fair price to free cash flow number and a fair price to earnings ratio number. Desired return of 13%. Let's see what that punches out. So it's going to crunch all these numbers here. The current price is $290.28. And okay, so the price just changed to $288.81, and currently the average calculation comes out to be $286.12. So folks, something to keep in mind here. The moderate average is $269. The aggressive side with 28% revenue growth is about $433. There's some big jumps in this number. But on average, $286.12 seems to be the number for this business. That indicates to us, folks, currently you are looking to get Tesla pretty much at fair value right now. It would have been nice to get this company at the low end, but something to keep in mind that if this business eventually gets hit on earnings, let's say hypothetically that they don't do well on their earnings and the company's stock price drops, usually that is a drop based off emotion. And obviously the opposite is true as well. If the earnings are met, usually there's some erratic action and people like to buy in by like just huge amounts because of the hype. So something to keep in mind. 286 might be your fair price for this business. Remember, in the long run, in the short run, the stock price is a voting machine, and in the long run, it's a weighing machine. If this stock price fluctuates crazy over the next, let's say, 10 days, in the long run, the stock price will always follow the business. To me personally, I think the stock price to pay for this business is in this 269 area. I wouldn't go past 269. 286 seems a little bit fair, but 269 will give you an additional margin of safety, and that's all we're trying to do, folks. We're trying to find great companies at great prices with a margin of safety, so that indicates to us that if we are wrong, we're not wrong so much, and we always put ourselves in some sort of winning scenario. So to conclude, we are pretty much almost at fair value with Tesla. And when the earnings report eventually does come out, and if you see the stock price jump up erratically, just keep in mind that if you believe the high average of 433, it's a buy all day. It's a buy all day. However, myself and probably many included like to try to be as conservative as possible because that's where we'll have the most margin of safety. Anyways, folks, found this video helpful, hit the like button, subscribe button, share with a friend. I will see you in the next one. Thank you so much for watching.